Expenditure method on GDP at market price. Definition of expenditure method. The expenditure method is a method for calculating gross domestic product, GDP, which totals consumption, investment, government spending, and net exports. This method produces nominal GDP, which must then be adjusted for inflation to result in the real GDP. Method and salient steps to calculate GDP. Under expenditure method, national income is calculated first by adding up all the items of final consumption expenditure and final investment expenditure within the domestic economy. The resulting total is called GDP at MR. By subtracting depreciation and net indirect taxes from GDP at MP and adding to its net factor income from abroad, we get NNP at FC or national income. Thus, under expenditure method, national income is measured at the point of actual expenditure. Expenditure method involves the following steps. 1. Identification of economic units incurring final expenditure. 2. Classification of final aggregate expenditure into following components like A. Private final consumption expenditure. B. Government final consumption expenditure. C. Gross fixed capital formation. D. Change in stocks. And E. Net exports. 3. The aggregate of these above items gives us the value of GDP at ME by deducting depreciation and net indirect taxes from GDP at MP. We get NDP at FC. 4. Estimation of net factor income from abroad, which is added to NDP at FC, domestic income, to obtain NNP at FC, national income. Precautions need to be taken while calculating. To avoid double counting, the expenditure on all intermediate goods and services need to be excluded. Secondly, the government expenditure on all transfer payments like scholarships, unemployment allowance, older age pension, etc. is excluded because no productive service is rendered by the recipients in exchange.
For more such videos on all subjects, practice questions and a lot more, download iPrep and learn unlimited.